This is Kitco Mining's special coverage of the Future Minerals Forum.
Hello and welcome back to Kitco Mining here at the Future Minerals Forum in Riyadh in Saudi Arabia with me, Paul Harris. Joining me now is Andrew Naylor, Head of Middle East and Public Policy at the World Gold Council. Andrew, welcome to Kitco.
Thank you, Paul.
Well, let's start with the main word in your organization's title, gold. Gold has traded down from its record highs of $2,800 per ounce, which it hit at the end of October last year, but it's still at a very healthy and comfortable $2,650 per ounce. What is your outlook for the gold price this year, and what do you think will be the main drivers there?
Well, certainly last year was a very, very interesting year for gold. 40 record highs. It was up around about 26% on the year. There were a number of reasons for that. Underpinning gold's performance throughout the year was central bank buying. We don't expect to see the 2022 records, but central banks have consistently been robust buyers of gold. They account for around about 19% of annual demand for gold, so they're a significant feature of the gold market. What else happened last year? It was really a bit of a tale of two halves. The first half of the year, we saw retail investment, particularly in India and China to start with, driving interest in gold. That changed as economic malaise in China set in. And as we approached September, we saw the US Fed start their rate cutting cycle, and that spurred institutional investor interest, particularly in the US, in the gold market. And a reflection of that, an indicator of that, was what has happened in the ETF, physical gold ETF landscape. So for the last few years, we've seen net outflows from physically backed ETFs. That flipped around about August last year on the back of renewed institutional investment interest from Western investors. So that was last year. This year, I think similar kind of factors are at play. We expect central bank demand for gold to be robust. We're starting to see a recovery in the Chinese market. The property market, for example, seems to be starting to stabilize. We've got data for December last year from China, and it's looking fairly robust. It's still down from long-term averages, but it seems to be starting a recovery. And India, which is the second largest consuming center for gold, we've seen robust demand from India throughout last year, partly because of the economic growth there, but also because of the fiscal and policy reforms that were announced in India, which encouraged domestic buying. We're likely to see that continue to impact the market. The big factor is still going to be interest rates. What's happening in geopolitics, the potential supply chain disruptions, these are likely to be inflationary, and again, that's likely to be supportive of gold demand.
Thank you, Andrew. One thing you didn't mention, next week the United States of America will have a new president, and Donald Trump looks like there'll potentially be a more adversarial relationship between the United States and China. Donald Trump has mentioned that he wants to impose tariffs against many countries regarding imports into the United States. To what extent or not will that be an additional driver to the gold price? Will that, and those increasing geopolitical tensions, will that be an extra stimulus to central bank buying?
Well, there's a couple of things to unpack from that. The first is the impact of geopolitical risk on the gold market. There's the Geopolitical Risk Index, a measure of general geopolitical risk. For every 100 basis point increase in that index, historically, gold has risen by about 2.5%. So that just demonstrates the role of gold, or the influence of geopolitics and geopolitical risk on gold's performance. It's likely that a lot of the new measures are likely to be inflationary in the longer term. Certainly if we're seeing tariffs and supply chain disruption, nearshoring, friendshoring, repatriation of supply chains, that's likely to be inflationary. Gold is seen as an effective hedge against inflation. The third area to look at is more broadly about the motivations for official sector buying. As I mentioned, central banks account on average for about 20% of demand for gold every year. We're expecting that or central bank demand to remain robust. We publish a survey of central banks every year. We published it last year in July. And from the 81% of the central banks that we spoke to think that gold is going to play a bigger role in portfolios this year. So the outlook from central banks, which are a big component, but not the only component of gold demand, is looking quite robust.
Let's talk about something now that the World Gold Council is working on, and that is the efforts of the WGC to create a digital gold, a project which is aimed at revolutionizing how gold is traded and used as a financial asset, with the idea that it would trade similarly to sort of cryptocurrencies, with the visibility down to 100th of a gram, potentially making it accessible and attractive to younger, more tech-savvy investors. How is that project progressing, and what do you think that would do for the gold market?
Well, without going to the specifics of the design, what we're looking at more broadly is the role of digitalization in the gold market. And the starting point for us was on supply chain integrity. So using digitalization, deploying blockchain to bring greater transparency to the physical metal as it flows throughout the supply chains. That was stage one, and we've been working with partners globally on that. Led on top of that is what digitalization can potentially do to improve how gold is traded, particularly in wholesale markets. So we do have a plethora of retail-focused digital gold products. They've been very important in expanding access to gold, particularly amongst younger investors. And what we're planning to do is to support that by looking at how the wholesale gold market, the OTC markets, can best leverage digital technology so that you get instantaneous settlement, you get greater data transparency, visibility on the trading close of gold. So there's lots of opportunities here, and digitalization is underpinning many of them.
I mean, it sounds very exciting. It sounds very necessary, and it effectively bringing gold into the modern age and be able to sort of trade it, store it, however. But the bottom line, do you think that will increase gold's appeal to institutional and individual investors?
I think it would. I mean, any form of expanded access will be supportive of gold. To give you an example, we've for over 20 years now, we've had gold-backed ETFs. They were revolutionary in attracting new institutional investment to gold, because for the first time they allowed pension funds, for example, which either had a regulatory barrier to investing in physical gold or a logistical barrier to investing in physical gold. That innovation of providing an equity wrapper around, at its heart, a physical gold product opened up the gold market to a new constituency of institutional investors. Digitalization is doing the same. We have a global program of consumer market research, and digitalization is a key theme that we explore. And younger people are trading not just gold, but other assets on their phones, on the internet. And digitalization of the gold market means that it was expand access to that group of potential and current investors.
Well, that's just maybe, Andrew, but and I think you mentioned in your comments earlier that despite the fact that ETFs are available and provide a relatively easy and efficient mechanism for investors to get exposure to gold and gold-related products, recent years have seen outflows from Western ETFs rather than inflows, despite higher gold prices, despite the positive, encouraging outlook for gold. How can the sector turn that around?
Well, the outflows, it wasn't really to do with the vehicle. I think it was to do with just global macroeconomics. It was to do with the higher interest rate environment, which increased the opportunity cost of holding gold. If you look at ETFs, ETFs are global. But if you look at the stock of ETFs and the domicile of ETFs, they tend to be domiciled in North America, in the US in particular, in the UK, Germany, and Switzerland. So their base is perhaps skewed a bit geographically, and it was the higher interest rate environment that was impacting institutional investment in gold. So I didn't think it was really about the vehicle, it was more about the general macroeconomic underpinnings of our market over the last couple of years. But that seems to be changing now as we're moving into a lower interest rate environment. We've got geopolitical risk on the horizon and other factors. That has meant that we've seen renewed institutional interest in gold, and that's been reflected by the net inflows that we've seen over the last few months.
Okay, now gold had a pretty good last year. It's up around 30%, give or take. But I think it's fair to say that investors have been disappointed that the higher gold prices have not supercharged gold stocks or gold company performance, to the extent that, I have to ask, have investors given up on gold stocks?
No, not at all. I mean, they play an important role. I mean, they're a different kind of exposure to gold. They're linked certainly to gold's performance, and gold's performance has an influence, but they're complementary. Physical gold is a little bit different because it's a physical asset. If you own it outright, nobody else has liability, and so therefore you don't have counterparty credit risk associated with it, potentially. So that means it fulfills quite a unique role in a portfolio. But there are other ways to gain exposure to gold and the gold price, and certainly gold equities are a key vehicle for doing that.
Okay, we are at the start of 2025. How does WGC, the World Gold Council, how do you see 2025 playing out in the precious metal space? Where do you think we'll be by year end?
Well, I can't forecast the gold price. All I can do is point to the big drivers of demand. So we've talked about the official sector central banks, which is about 20% of annual demand for gold. The other areas to look at, technology. Technology is about 7% of demand for gold. It tends to be a pro-cyclical element of gold demand. When the economy is doing well, people buy more tech, gold is used in tech, gold demand goes up. That's looking at the moment fairly robust. If you look at where gold is used in technology, there's significant demand, LEDs, printed circuit boards, and so on. The other areas to look at are on the investment side, which we've spoken about, but on consumer demand. Consumer demand is more of an emerging market story, and really it's often a bet on India and China, and certainly India in particular is seeing very, very robust growth. And that we expect to support gold demand, consumer demand in India. So I think the fundamentals are there. The macroeconomics seem to be quite supportive. We're expecting further interest rate cuts, particularly in the US, and that's likely to support gold demand.
A lot of analysts are anticipating $3,000 per ounce, US dollars per ounce gold price by the end of the year. Is that something that WGC would concur with?
I'm afraid we don't forecast the gold price, so just point you to the various different analysts that are out there.
I have to ask. Andrew Naylor, thank you very much for joining us today.
Thank you very much, Paul.
And we have a lot more to come from the Future Minerals Forum here in Riyadh, Saudi Arabia. I'm Paul Harris, and this is Kitco Mining.
This is Kitco Mining's special coverage of the Future Minerals Forum.